quickly get in a perspective on the sidelines of the Motilal Oswal Investor Conference. Taher Badshah, who's Senior Vice President at Go Ahead Equities, Motilal Oswal AMC, joins in with his perspective in the markets. What's been the mood like and the response like so far, Taher? Very good afternoon to you at the conference. And do you see that people are talking, 8,000 of course is pretty much on the cards, but are really talking about more upside for the markets from these levels?
Good afternoon to you too. Actually, we've got a very good session going out here over the last couple of days, and very thick participation too across various kinds of clients. We've seen quite a lot of enthusiasm out of corporates as well, and both from the private sector side as well as the public sector. And we've seen quite a lot of discussions regarding policy as well. So overall, the mood is pretty positive. We remain pretty confident about the fundamentals of the overall direction of the economy, and I think from that perspective, yes, maybe hard to call the market trend over the next some days or weeks, but clearly if we were to probably look out 6 months from now or 3 months from now, the trend clearly seems to be upwards, and we could probably be looking at levels higher than where we are today over that period.
Sector-wise, the debate between cyclicals and defensives continues, even though the market gets a bit more polarized and the interest revives in some of the defensive sectors, especially some of the consumption-led themes in the market. Do you see that debate continuing? Do you think that there needs to be a balance? Is that what investors are sensing, that fine, you need to benefit from the value-oriented cyclicals, but you also can't ignore completely the growth visibility coming in through defensives?
You said it. I mean, I think that's the best way to play it, in especially the first few months of this government, when policy could probably see a little bit of flip-flop, and we could see certain things getting ironed out, and in which in that process we could see some of these cyclical sectors getting hurt, like what happened yesterday, for example. So to that extent, to have a good balance between some of the consumption-related names and investment-related names makes a lot of sense. Both are beneficiaries of the likely growth in the economy, so it's not even from a longer-term perspective one at the cost of the other. We believe that the consumption theme and the consumer discretionary theme will remain a very solid theme, and it's not going to be about a defensive nature of the business. It's just that those sectors will also witness a lot of growth as a result of policy action, as a result of cyclical recovery of the economy. So I think it makes a lot of sense to have a good even balance in the portfolio across both these sides of the market.
Taher, Neeraj here, and good having you, of course. The thing that we've noticed the last maybe 3 odd months, or at least I have noticed, is that a lot of these second rung names in terms of market knowledge, essentially. So Hitachi Home is not necessarily a second tier company in terms of the products that it may be making, but we hear a lot of these companies making a move. Whirlpool is now 500, it was at 400 maybe a week before it came out with its numbers, and splendid move there, and it's had a good move till 500. Hitachi Home, Symphony, a lot of these durable companies are really getting recognized. What are you guys liking within this space, if at all, even after the run-up?
Yeah, so we've also played it in that. We've also played our stocks in that segment, and we believe that segment still has a lot of potential. So the likes of let's say Havells or Voltas, which figure in our portfolios, even consumer discretionary stocks in the segment like retail, or let's say things like QSR and so on. They are all basically beneficiaries of the fact that we are getting into, in some businesses, inflection points where the demand could really take off in a J-curve fashion in the next few years' time, or in some other cases where demand has probably moderated or slumped, but they are businesses which have got a lot of operating leverage residing within them, combined with the fact that they maintain very good, strong leadership positions in their respective lines of business. So as and when the recovery comes, even though they might look to be or appear to be trading at fancy valuations, they could probably show a very exponential growth in earnings. And that's what is basically driving many of these companies, just the recognition of the potential of growth in these segments, and probably many of these also cater to the semi-urban and tier 2, tier 3 requirements, and those are where we are going to search for more growth as we go along. So to some degree, many of the stock moves in these kind of product lines are actually justified.
Just that to re-emphasize that point, look at a Lloyd Electric, for example, a company which was essentially a company that used to be a supplier to some of these some of the air-conditioned companies like Daikin, etc. But I think it's caught fire, up 5% today. A few days ago, I saw it at 140 or 141. Good financials, good numbers, and up 5%, has gained almost 15% in the last few days of trade. So really good going for some of these companies. Consumer durables are certainly doing well. There on your screen, Whirlpool, it's up a whole 10% at 505. So really, really good show. So that's one basket that's done very, very well. Havells would probably fall in that bracket. The other one, Taher, is something that I've heard you speak very well about, and that's autos selectively. So you guys have been very bullish on iShares, and it's a known story that stock has done very well. TVS has come up leaps and bounds over the last maybe year and a half. A lot of people are now talking about upsides coming in stocks like Ashok Leyland as well as the iShares CV division too. What's appealing to you now within the auto basket? What is it that's featuring in the conference that you are recommending to your clients to do?
We've had essentially a couple of the auto companies, the large auto companies like Hero, etc., present yesterday. While we've had a very strong overweight in this sector across many of our mutual fund schemes, we've basically played it through some of the leaders in this in their respective categories. We've had most of the frontline OEMs in our portfolios, and not hard to figure that we are essentially betting on the one is of course the cyclical recovery component, but many of these are large franchises which have got very dominant shares, dominant positions in their respective categories. So there are cyclical plays in this, and there are also structural plays in this, either driven by category changes, like for example in case of scooters, or probably in case of companies which are going to be driven by cyclical recovery, like for example in case of the car market for that matter. So I think that's how we've played it. We've basically tried to identify the leaders. We essentially like to stick to the leaders in most of the in most of the business lines, not just in autos but even in other sectors where we believe that position is still dominant and they've got their ability to continue with their dominance or expand over their dominance in the coming years. So I think as a sector we clearly like it. We have a lot of interesting names, each in their own way, having their growth stories which are likely to unfold over the next few years.
CNX 500, but a lot of these names are really moving around. Taher, I would just request you to stay on for a moment, because somehow we need to address this theme that is happening right now. I understand you can't talk stocks. Let me take it to my technical experts thus and talk about some of these names and the way they are moving. Ashwini, you want to here? We've spoken about our Havells, but look at some of the others, the likes of Whirlpool, Hitachi. I also saw Lloyd's Electric. Some of these consumer durable companies are moving thick and fast right now.
Even Voltas is moving. I don't know whether you call it consumer durable or capital goods. So some sort of sector move is happening right now. So clearly it appears that this space could outperform going forward. So basically our pick here is Voltas. We should look for targets of 260, 265 here.
Right. Of course, you've seen traction in other names as well. Voltas is the call that Ashmi has just given, but Apollo Hospitals. There's also Whirlpool that we highlighted a little while back. Mitesh, come to you on an Apollo Hospitals as also a Whirlpool.
See, I think we had a buy call on Apollo Hospital. In fact, that's also my 320 strategy. I think closing at a fresh high after some days of consolidation and pullback. The stock is resuming its uptrend. I think the next target should be around 1250, 1260, which would happen in the next 5 to 6 sessions.
Okay, Taher, the other move, the last 3 years, the last 2 years, 1 year, last 6 months, probably the last 2 weeks, has been pharma. It's been one rank outperformer, and and I don't know if you can call it defensive at all, because it's just a space that keeps on moving irrespective of the market condition. If Cipla was the one that had not moved till now, even that has done its bit now. What does one do? Large cap, mid cap, pharma, because all of them are individual stories. It's not necessarily a sectoral theme, even though they have moved in tandem. What do you like in pharma?
So precisely, I think the point is that these are, it's probably it's becoming hard to characterize these stocks just as defensive, because they're showing ample amount of growth. In fact, they're almost oozing with growth compared to many other sectors, and that's what the market is essentially chasing. It's all about growth, and we've seen many of the mid-sized and the large cap pharma companies perform equally well. So it's again there, you have to make your choices, because in pharma, unlike let's say in case of a tech sector, probably just one tailwind or just one factor does not apply to all the companies. Many of the companies in the pharma sector are diffused in terms of their business models. Some are more active in the domestic market, many more are active in the overseas market. Their product positionings and their pipeline of products is quite different from each other. Many of their business models are different. Some are acquisition-led growth. So we have to differentiate between these. Many of the companies have a different charter in terms of the way they want to grow over the next 2 or 3 years. And of course, there is the regulatory issues which keep coming every now and then for some of these pharma companies. So we have to basically skirt around these issues and try and find out companies which one likes. So in a way, while we are overweight in pharma, but we've basically played it through a couple of names. So we have very concentrated positions. We like some of the dominant names in the large cap and the mid cap space. Unfortunately, I'm not again at the liberty to reveal names, but that's how we are basically approaching this sector. So there is not a homogeneous sector as such to play.
What happens to oil and gas then? ONGC, Reliance, and the oil marketing companies?
So we like some of the upstream ONGC, oil and gas companies as well. That is again a sector which probably has a lot of merit for itself from the point of view of product categories getting liberalized in terms of their ability to price in the market, both in terms of petro fuels as well as in case of gas. So as the products of these companies are able to derive market link prices, and it's more about government intervention. So it's a low hanging fruit for many of these companies to actually boost up their earnings if they were to probably get these more market linked or market determined prices for themselves. So earnings revision can come very thick and fast in these companies, not to mention the fact that a declining crude scenario and a slightly stable to a stronger rupee will also aid to the overall process of re-rating for these companies. And then again, we are very dominant in the sense that it's very hard to see new companies in the oil and gas space come and extend the overall competitive environment for the existing companies. So to that extent, it's a fairly consolidated sector as such, which provides very large dominant plays. We like the upstream oil and gas sector as well as some of the downstream plays.
Taher, the last question, at least from my end, what is the top theme at the conference? I mean, if your top client comes or if Motilal Oswal's top clients come and ask about that one space that they could be bullish on for the next 1 year, what is it that you guys or you in particular personally are convinced about?
Quite a tough one. We've seen shades of both sides over the last 2 days. In fact, yesterday was more about the existing businesses and the continuing of continuity of those businesses and the continuity that these companies offer as we go along in traditional product categories. And today it has been more also about companies which are going to be reshaped because of the technology revolution. So be it on the side of banking, be it in of course IT, and of course certain other thematic discussions around certain companies which are going to lead the change through the online drive for existing businesses as well as new or emerging businesses. So it's a combination. People are trying to find winners in both the categories, and I think that's what more than anything else. That is what is exactly what people and investors in this conference are hunting for. They're basically trying to find winners of the next 2 years, 3 years, 5 years, could be out of traditional businesses or could be out of new generation businesses.
Alright, we leave it at that. Thanks very much for joining us with your views, and we wish you all the best at the conference. And of course, I hope that there's more investor interest in the market as we go along. Okay, change tracks. I just want to go across and get in a quick perspective on what dealers are recommending at this point, but just want to also highlight the Nifty, which is up about 7,900 marks, with a flash in the green really coming in. Remarkable recovery from the lows of the session, but